Holdings. How are you, sir?
Hey, good morning.
Morning. Antonio probably doesn't need an introduction. You've been here now so many times.
4 or 5.
Four or five. You run J.P. Morgan Private Bank here in New Orleans.
Yeah, thanks for the promotion.
Yeah.
No, I am a banker here in the New Orleans office. We do also have a Baton Rouge office in Louisiana.
So before this, Antonio puts a slide deck for us together that's always 46 slides approximately. And so really my first question to you today, has the last 72 hours or last week and a couple days, 9 days, transformed everything? Or was this all expected?
We don't think so. So jury's still out. You could be referring to a number of things. Number one, we've had the inauguration and the new administration in the presidency. And then since Christmas and really bulking up last week, we had the news about DeepSeek, which was a pretty significant leap forward in artificial intelligence technology. So I can touch on both of those, but those are fundamental themes to what we're looking at in terms of our outlook for 2025. The disruption may not be as much of a disruption.
Okay, right.
As news and the markets made it out to be yesterday and the day before, but we're still in wait and see mode, and there's still some things we don't know. So that's kind of what I wanted to go through today.
So there's a lot of this was just promises, right, that we were going to do. Mm-hmm. Certainly some of it was not. I don't think anyone anticipated we're going to offer the entire federal government to leave their job and pay them for 8 months, right?
We had to do something. So the important deadline that's coming up in the first quarter of this year is that Congress has to pass a budget, has to come from the House.
Yep.
So that obviously a lot of campaign promises are made, and the big fact is how are we going to pay for it? So lots of campaign promises: no tax on overtime, no tax on tips. We're going to cut taxes. We're going to extend the TCJA. We're going to extend all of those exemptions. Mortgage interest tax deductions going back up from $750 to $1.1 million. All these things are going to happen, but how are we going to pay for it?
Right.
And there was, very specific proposals on tax cuts and very vague answers on payment. So, yeah, the furloughing of or the offers to a lot of federal employees is just one way to go about paying for that.
I'm going to switch Antonio.
Okay.
I'm so sorry.
Oh, this is going to be a tough one.
He did ask to test it, and we told him no.
We said, it's probably fine.
We said, here, we just got you here. Here, you can keep that. Keep that. We'll just switch the pack.
I do apologize.
Am I doing any better with this one? Sorry, you're all going to have to hear. See my wires.
It's hard enough when you have to do it with all the time and not in front of people. So you're right. So we got to balance we got to balance the budget. Yep. And there's a lot of ways to do that. I think we've talked about that, many times coming up to this. So how does this administration do that?
So they've got a number of avenues open to them, and there's been a lot of discussion of tariffs. And so I've got a couple slides and things like that on the subject of tariffs. But yeah, it's going to. The government has staked a good bit on Elon Musk and DOGE, the Office of Government Efficiency, that says that there is enough inefficiency and loss in the government that we can simply make it all more efficient to recoup for the tax cuts. By our analysis put out by Michael Semblist, who writes our Eye on the Market, that's an uphill battle. You cannot pay for all of the tax cuts that the Trump administration would like to extend without touching entitlements, because, again, one of the slides I've gotten here.
Yeah, and you can see them, and you can...
So, but the long and short to finish the thought is that you really can't pay for all of these cuts without touching entitlement spending, which means things like laying off federal employees, touching Medicare, Medicaid, Social Security, changing the retirement age, changing the benefit amount, changing the inflation engine. You've got to touch the fundamentals of U.S. entitlements, and not popular, not likely, not what Donald Trump ran on. So,
but what's happened is kind of interesting, right? This move of the $2 million, will pay you for 8 months or 7 months, and Godspeed. Seems like what happened at Twitter, now X, right? And
right.
It was
You're
like,
gonna
I'm going to
run
call
leaner.
in, I'm going to
Correct.
call in, and I hope to just shred. I don't know.
We're going to run this whole thing with fewer people.
Yeah, and you're just going to work harder. Yeah.
So it's a cost-cutting measure. We will see how far it goes. It's already been blocked by a federal judge. So again, we're on pause for right now. But clear to say that the new administration came in with a plan, more executive orders in the first week than any administration in history, certainly in the 20th century. And so this is a lot of aggressive moves. And with Donald Trump, we've got to see what is a negotiating tactic versus what is policy, because certainly on tariffs it can be both.
So how does the bank hedge their bets, though, with whether it's legal or it's going to be blocked in the courts? I mean, I assume that it has to be part of your analysis and calculus of this is negotiations, or like he's going to say that, but we've now checked with our legal department and there's no way this gets pushed forward, or do we just accept the chaos?
Total level of impact is, again, I want to emphasize the budget that needs to be passed, because the powers of the executive office are limited. Donald Trump, as you read, is determined to find out exactly what those limits are, but it is limited. And so the overall impact to the economy, to the fundamental ways that many Americans operate, it's not going to be changed by the president alone. He's going to need support from Congress. He has a very narrow majority in the House, and so drastic overhauls are going to be difficult. So we hedge according to the mandate, and if you were to listen to Donald Trump, obviously he thinks he's got a very clear mandate, winning 1.5%, winning the popular vote by 1.5%. But it's a finicky Congress, and 3 votes in the House it's easy to lose three congressmen on any vote, and so that, I think, has tempered some of our expectations for a total overhaul.
Though he seems to have a better pool than most at getting
them all on the same page, getting them to do what he wants. So
public shaming and all the tactics in which he's well known for. So another one of the policies is halting the release of funds, which was again blocked. Yesterday, the White House said, well, direct federal funding should go forward. We're really aiming towards any indirect and also foreign review. Almost setting us up to be isolationist, like true isolationist of a sort.
That is the threat.
Okay.
So again, let's...
So you would categorize it as a threat. Like, what does that actually mean for the economy?
Let's look at how it played out in Colombia over the weekend. So, somebody did not do what Donald Trump wanted, to land in a few military planes full of deported citizens that were returning to Colombia. Colombia did not want the planes to land. Trump threatened tariffs that would hinder the Colombian economy pretty significantly. They were in place for all of 12 hours. As soon as the Colombians complied and allowed the planes to land, the tariffs were lifted.
Yep.
So, not to say that Trump's not exactly as good as his word at what he says he's going to do, but how much of it is policy and how much of it is negotiation? So,
No, I completely tracking that. So you're saying like just the threat or the negotiations. It's not necessarily the threat to the economy if
no.
something
and also, so we got to take this step by step. Let me just level set with a few slides first, and then we can take it back to the questions. So just want to recap 2024 really, really quickly. My charts are a little bit messed up here, but the point of this slide was to say, across the world, everything on this page, from stocks, bonds, gold, commodity, U.S. markets, foreign markets, treasuries, bonds, were up in 2024. There were no negative bars on this page. So even with interest rate volatility and all of those things, you made money. Even if you were in cash, you were getting paid 4-ish%. So good news kind of around the world in terms of global coordinated growth. and that is a trend we expect to continue.
Yeah, but for inflation, does that reduce these numbers? Inflation's included in these numbers?
No, these are total returns, but it does not include inflation.
Okay.
That's my next slide. So this slide should look familiar. We have revised it actually very slightly since this was published, that we are in soft landing mode. We have landed.
I thought last time, I thought you already called it.
Correct. And
I still don't believe it.
I mean,
but
we're here.
I keep telling myself.
So the risk at this point is skewing more heavily towards inflation because of the combination of policies that are coming out of the administration. We'll touch on that in a second.
Okay.
The risk of recession has actually shrunk since this chart was published. It's down to 10 or 15%, which is the lowest that the bank will ever put it. It's never a zero. You can always have a sort of tail risk event. But recession is very unlikely at this point. Inflation is the greater risk, but our base case is for a soft landing. Cody, to your point, so last year we did put positive real GDP growth on the books again.
Some record quarters, not record quarter. I mean, but some significant
good quarters.
Yeah.
And I'll hit on that in 1 second. So GDP growth, real GDP growth is positive. My right-hand chart got messed up too. Those bars are year-over-year inflation growth, and there are some stars that we're showing the highest point in the cycle. Inflation is down across the board is the point of this slide.
I'll pull up the PDF if we think it was.
Yeah, we got some pretty significant
some movement,
missing pieces. Yeah.
All right.
So inflation has come down off of cycle highs, and through 2023 and 2024, my next slide is saying that GDP growth beat expectations consistently, both years. We came in higher than expected. And so the forecast for 2025 is looking at 2.1 to 2.3% GDP growth based on current expectations, barring any major changes in policies. But that's positive, and that's above the trend line growth that we were seeing for all of the 2010s. So there's my diamonds that are back. These diamonds on the right-hand chart are showing you the highest point of the cycle where inflation was. Our forecast for inflation in 2025 is 2.5%. Remember that the Federal Reserve has a target of 2% is where they want it to be for their decisions on cutting. We do have a Fed meeting today. No action is expected. It's supposed to be a total dud. No new information really coming out of it, but that is 1 p.m. this afternoon.
Yeah, why would they do anything today, right?
Yeah, so this was what I was just referring to. The dark blue bar on this chart is what we thought GDP growth was going to be, real GDP growth was going to be. The light blue bar is what it actually was. So came into 2023 expecting 0.3% GDP growth. We got 2.5%. Revised our expectations upward. 2024, we thought we were going to get 1.3% GDP growth. We ended up with 2.7%. So now our outlook for 2025 is projecting out 2.1%. And we are on trend to meet that pace, barring any major changes.
How does this compare to the rest of the world? Like,
the U.S. economy is leading the pack. Europe has struggled. We're going to talk about some of the themes and why they're more prevalent in the United States. But I would say the U.S. economy is certainly between developed markets such as Europe and Japan, China, or emerging markets. The U.S. economy has been the place to be.
Outperforming China. China is not meeting expectations.
China has a higher GDP growth percentage. They're forecasting about 4% growth, but they have a lower base, and it is, again, versus their own expectations, not meeting what they'd like to do.
Okay.
After decades of 10% GDP growth rate. So here's what we want to talk about today in terms of the outlook. There's 5 key things that are in our outlook for 2025. For you guys, I'm going to focus on the first 3 that are most directly relevant to kind of what you do. First is easing global policy, Fed cutting rates. We've been talking about it for the last 2-3 times that I've been here. Number 2 is accelerating capital investment. This is part of the reason why the U.S. is leading the pack. So things like AI, infrastructure, power generation, these are fundamental to the growth story in 2025, and also some of the things that were most challenged by the news from DeepSeek over the weekend. So that's the expectation that's being challenged there. And then understanding election impacts. I got a couple charts. We're going to hit on some of the things we already talked about here. and what to expect from Trump and the Republicans after they have control of the House, the Senate, and the presidency. So I will skip those last two for the sake of time, but just level setting here. We are underway with Fed easing. The yield curve is now positively sloped. What does that mean? Your cash rates are coming down. We've seen more than a full percentage of rate cuts. I think last time I was here, we were just about to start, and we really had only gotten our first cut. We are now expecting at our meeting today that there will be a pause, but there will likely be one or two more cuts from the Fed through the rest of this year.
And so you're seeing a slow incline, just a bit, takes us up almost 1%?
Yeah, well, we've already seen a 1% decline here. The important thing to take away from this page, we are not going back to zero. We're not, based on this chart, it looks like after the hump that you go back to zero. The Fed is making these decisions based on unemployment and inflation. Unemployment is currently riding at 4.1, 4.2%. Their target is 4, so they're pretty close, not terrible there. Inflation is trending, as I said, our expectation for 2025 is 2.5%. It's currently a little higher, depending on which measure you look at, 2.9 to the low 3s. So inflation's getting closer to their expectation. Unemployment is in line with where they want it to be. That means that we're getting close to the neutral rate, which is the rate at which things are no longer accommodative or restrictive.
But with the new administration and changes that are occurring, what happens to unemployment? I mean, does that must go up?
Maybe not.
So
let's talk about that for a second. I'm going to get there.
Okay.
So the other outlook that's important for you guys is this chart is showing you, based on where the Fed funds rate, where do we think the 2-year, 5-year, and 10-year yields. Why does that matter? Because this is how mortgage rates are set. Short-term things, and I said this last time I was up in front of you guys, things like ARMs, 3 years, 5 years, 7 years, they're going to start getting to be more attractive than your 30-year fixed. You may have to look at other options when financing properties for your clients, but this is our expectation for, based on where the Fed lands, finally, where the resulting 10-year would be. So the highlighted box in green is if we see 2 more rate cuts from the Fed, that lands us around 3.75 on the Fed funds rate and 4.5% on the 10-year yield. That you can expect mortgage spreads to be 1.5% to 2% above that. That's a 6 to 6.5% mortgage rate on the 30-year. So not terribly exciting, but at the 2 or the 5-year end, things might be getting down into the 5s-ish, more interesting numbers there that help some deals go through.
And the significant changes that's happened with the Fed rate really in the last, 4-6 weeks, expected, unexpected?
Expected.
Yep.
We knew that the Fed knew that they were in restrictive territory. They knew they were slowing the economy. The economy has remained remarkably resilient, but luckily inflation has come down quite a bit. It's not where they want it to be, but it's come down significantly. And unemployment has ticked up, but not to concerning levels. So last time I was here, or actually this time last year, we're looking at the unemployment rate in the 3s, 3.7. So going from 3.7 to 4.1, it's in line, not signs of major weakness in the economy. Winning the fight against inflation is more important at this stage, and we've made a lot of progress there. This one is just showing you the global central banks. More people are in cutting than in hiking mode right now. That is accommodative. That makes good things happen in the stock market, the deal-making market, liquidity events. The chart on the right is showing the IPO market, M&A deal activity, picking up. The other major force behind this that will come from new Republican administration is they have been strong in their desire for deregulation. That affects things like financials, banks, as well as IPO and deal-making markets. There's a lot of mergers and acquisitions that got axed or questioned by various government administrations. In a world of deregulation, this activity should pick up. And that is generally a good thing for the stock
we saw
market.
that in the airlines. We saw that in tech in the last couple of years.
Yep. And you've seen it in bank earnings, which have just released over the past week or two. So this is our outlook for the stock market this year. We give you a base case, a bull case, and a bear case. The base case is for about 6,400 on the S&P by the year end of 2025. We're just above 6,000 right now. That gives us 6-ish% upside from here.
Y'all never say 20% like we've seen.
No,
you're never that bullish.
No, we are not. But that is based on the fact that we are generally not calling for major multiple expansion. So actually this year, as I said last year, we were calling for multiple contraction. And that is what we did not see. The market is still paying a higher earnings growth multiple, meaning they're paying more for stocks than we would like to pay. But the earnings story is very strong.
And this is because economists are all pessimist, and
or bankers are cheap, because we don't like paying a high PE multiple for stocks, especially in a slower growth environment. But when companies like NVIDIA have been as good at their word as at delivering earnings growth, then the market's willing to give them the benefit of the doubt. So that is where the bull case, that green line up, that's probably another 10% from there. So yeah, that's where you see the significant upside if you don't see that multiple contraction. And then obviously, if the price to earnings multiple were to revert to the mean, meaning like the average of what we typically pay, and GDP growth were really just slow, that is the bear case at an 18 times earning is that red dotted line. Kind of takes you back to where we were at the beginning of 2024.
And when you say 18 times earning, what does that really mean?
So if a company earns $1 per share, you are paying $18 for the stock, meaning 18 years worth of that earnings. Now, for many people, as you think about buying a piece of real estate or something like that, would you want to take 18 years to recoup your investment and what you're buying a stock for? No. You're buying that because you believe the earnings growth is so strong that next year it's not going to be $1 a share, it's going to be $2 a share, or $5 a share, that it's going to grow fast enough that it won't take you 18 years to recoup that investment. So these elevated price to earnings ratios are on the back of expectations that S&P 500, the largest 500 companies in the United States, will be able to grow their earnings at a double-digit rate. We're saying 12% this year.
So much of the growth has been in the IT sector or tech sector.
Yep.
Is that still going to be the case for 2025?
Yes, probably. So the second theme that we're hitting on here, thank you for teeing me up, is the year of capital investment. And there's a lot of areas that you can, when we talk about capital investment, we're talking about companies putting money in the ground to develop new R&D, new data centers, new power generation, new autonomous vehicles, new whatever, at healthcare research centers. So there's a lot of money being put in the ground right now. Locally, Jeffrey asked me to hit on, we have in North Louisiana, not too far from here, a $10 billion project underway, the largest data center that Meta is going to be building in the United States in North Louisiana. Exactly. And not only, so this is combining the themes I'm talking about, not only is it Meta's largest data center in North America, it also comes with 3 new power generation stations, 3 new power plants from Entergy. So it's a partnership between Entergy and Meta to meet this shortfall.
It's why Texas lost
natural gas.
Yeah, and so it's all LNG, and so it's coupled really when we think about this local investment. Our largest infrastructure project is the LNG.
Yep.
And so we train.
We're gonna get a train here.
So we really have 2 ginormous capital projects we can see in front of us.
So who's this good for? So the leaders, and actually coming out of Louisiana with this data center and this energy build out, we have the experts based out of South Louisiana, the MMRs, the Turners, the whatever. We have large mechanical contractors who build these data centers, who build the pipes, and so you've got constructions. This Meta thing, so when you think about people buying houses and where they need to move, and you say, well, a data center doesn't create a ton of construction, or it doesn't create a ton of permanent jobs. It creates some. But also the construction of this data center is going from now until 2030. So that's 6 years of hundreds, if
it's
not
on time.
thousands well, they're on time. Let me tell you, this is a different. I was reading last night in NOLA.com the sort of breakdown of how this politically pushed through, and I think in South Louisiana, we're not used to doing business with the type of people that are now investing in us. So when you talk about Meta wants this done and gets it done on time, they're willing to put more money and resources into. We're already done with, or well underway on the first quarter of the project. But this is 6 years of construction. That's enough time for someone to be
billions and billions of dollars of investment.
Correct. So if you look at the render of the project, it's like 4 data centers that are on the same site, and so the first one is well underway and moving quickly.
So, I'm curious, how Louisiana got out of 50 states?
I've got to defer you to the NOLA.com article that I just read last night. There was a competition that Meta knew they wanted to put this particular data center in the South, so it was us versus Mississippi, Alabama, Texas. The fact that we won out over Texas and some of the more obvious choices, there's a story behind that. Obviously, it comes with tax breaks. It comes with being able to cut the red tape and provide the incentives to...
and Texas is deregulated in their energy, and so you don't necessarily know what that cost is going to be.
Texas is a whole separate grid.
A data center is all energy cost associated, and so they could contract in with Entergy and have
It seems, based on the article I read, the linchpin to the deal was being able to offer a sales tax exemption on all of the GPUs and the server equipment that they needed to buy and put here. Other states have that written in, like Texas has that written into their laws by default. If you're buying a certain amount of server equipment, it's automatically sales tax exempt. Governor Landry and a lot of our state congressmen had to do yeoman's work to force this through. It's an interesting read. I definitely encourage it. But so that's the data center. And then the other piece of this. So let's just think about this for a second. U.S. energy, electricity consumption has been more or less stagnant for the last 20 years. Despite the fact that our GDP has been growing, population has been growing, pickup in energy efficiency, all those energy efficient appliances and things that we do, has meant that we don't need that much more electricity than we did in 2005.
Amazing.
That, on the back of data center and all of this power generation, is changing really rapidly. 3 power plants had to be on the site for this Meta facility. What happened? Over the weekend, we had the news from DeepSeek, and DeepSeek basically created a new model that used some creative engineering to make it significantly more cost-effective to train their model and reduce the cost of delivering that to end users.
Had y'all been talking about this company? Had you heard of DeepSeek?
No, DeepSeek is very new. It's actually a spin-off project from a Chinese hedge fund company. He was a mathematician who basically did it as a side hustle. DeepSeek uses open source technology, so it's nothing proprietary the same way that OpenAI's is. And there's actually some data that it seems like DeepSeek violated OpenAI's terms of service and actually used ChatGPT to train their model. So that speeds up your ability to catch up to someone when you literally use their model to feed yours. And so it was still a feat of engineering. It's still a great project, but it won't push the bounds of AI technology. It's just an astounding catch-up to what is already out there. And the fact that the interesting thing about DeepSeek and why the markets, I think, took this so seriously is A, that it's open source code, so anyone can check it. There's no secret normally. People are, myself included, very skeptical when a Chinese company comes out with outlandish change about how they revolutionize AI. This is open source code. You can go look at it. Not that I can make anything out of it, but the people who looked at it said it's pretty legit. And the second thing is that they accompanied it with a scientific research paper that explained exactly what they did from a value engineering standpoint to make it more efficient. So what does this mean? The markets interpreted this. This is net a good thing for AI. Over time, we believe that AI will become cheaper and more cost efficient. The news from DeepSeek basically just leapt us forward on that curve. And that is a bad thing for hardware producers. Taiwan Semiconductor stock was down, NVIDIA stock was down. Some of the power companies that are most invested in these really energy-intensive projects like Constellation Energy and Vistra got beat up in the market. But the beneficiaries, the people who use AI to deliver to their clients, think Meta or Amazon, were actually up. Actually, Apple was up pretty big because Apple's been a little bit slow investing in the AI space. So watching everyone else kind of dive headfirst into the capital expenditures, now they're in a better position to take advantage of the more efficient version of this. So end users, there's something called Jarvin's curve that is basically the idea that as a resource becomes more efficient, consumption of it may actually increase. Think about it, let's say jet fuel for airplanes. If airplane engines become so much more efficient, they burn a whole bunch less jet fuel, you would think that would lead to less jet fuel consumption. But what really happens is airlines are like, great, we can operate flights cheaper, we'll offer more routes everywhere, people will fly more, and jet fuel consumption actually goes up because the average price per ticket is cheaper, so there's more demand for the good. That's basically what just happened for AI, is the cost of it just dropped, the efficiency increased, and a whole bunch of use cases that might not have been tackled for years can be tackled sooner. So net, it does not derail our thesis that when Meta builds a $10 million facility in Louisiana, they're going to have a use for that facility. But the spread of uses, it's going to power even more. You're going to get more AI output from that facility than you previously expected.
I'm going to ask the question. I think the answer is obvious, but there's still some economists that think this next year is going to be whether AI kind of is a bubble. And they would point to, everyone says we need to use it, but like 5% of companies are using it in any sort of meaningful way, which it's now been around for years, and like people just don't fully even know how to incorporate it. We're not betting on that at all as an economy, or, I mean, clearly
this is going to have an impact on the economy, and I believe that the stage that we're in is still fairly rudimentary of what you need to do and what you need to feed into an LLM to get a useful output of it is still too much. As AI advances, it gets better and it integrates, at JP Morgan, we have our phone lines that AI can do automated call notes for us. I think I told you guys about that last time. Now AI is integrated into our software that allows us to give recommendations to clients, and so that AI can go back and read all of our call notes. So not only are better call notes about every conversation I've ever had with one of my clients getting put into the system, there's now something better that's going back and reading those call notes and feeding me ideas of, hey, so-and-so said they were really interested in this stock, and now the stock moved today, you should really call them. So there's better data being put into the system and something better reading that data to give you a more constructive outlook that makes me more efficient at my job. And we're still in this rudimentary stage where like AI is still helping us generate a ton of new data that's going to make itself more useful. But LLMs and Gen AI, while very cool and entertaining, are not the sort of base case of what's going to revolutionize the U.S. economy. Large language models. So those are the basically like chat bots that you can talk to. Now, where it does change.
Curious. I would like to dive into your comment. It's not going to change the U.S. economy in a large way. Is that what?
The LLM alone.
Okay.
But AI will.
Okay.
So
AI will.
We have now reached the stage of AI. Mary Erdos was in Davos, the major economic forum in Switzerland, and they were demonstrating a client service representative that had all the human, like Mary was stunned in the fact that she literally spoke like a person with the correct pauses, inflations, and ums, and offered client service to someone who was calling in imperceptibly from a call center attendant. And that is the point at which AI is powerful enough to change the jobs market or the outlook.
Yeah, I can't think of an industry. I mean, more and more like we dive into it, that AI doesn't have an effect. And like when we go to look and pick stocks and such, it really is, what opportunity can I envision this company has, even if they don't have it today,
And so Silicon Valley is looking for, I read an article in the Wall Street Journal that was titled Silicon Valley is looking for boring businesses because they're looking for ways to apply AI in property management. All right, talking to a bunch of realtors that can make...
That's not boring.
That can take so much of the administrative work about what happens on the back end of accounting or property management, managing lease agreements.
Somebody has a
files.
problem,
Correct.
and how that gets solved, even without the agent, or just the agent's oversight versus the agent calling this person, doing this, figuring out
right.
what the
You're just
need
going to
is.
get a notification if you need to go somewhere and actually get something done and show up as a human being.
Even pricing applied to almost every business
But-
being automated and smarter and predictable.
And the accounting on the back end of it and putting out the reports that people need to understand the generation of their rental income or whatever it was, so that the accounting functions, the property management functions, the utility functions, any sort of coding or bill reporting. So AI is in the process of tackling and making business models that are going to revolutionize sort of the day-to-day of the way a lot of us operate.
Yep.
I'm slowing down. Trump taking office. We are looking on the left-hand chart is the number of economically significant rules and regulations under each of the past presidents. And so you can see Trump kind of in the middle for his first term. Biden was, along with Obama, the most regulatory restrictive. Trump has come in with a vengeance to try to undo as many of those policies with individual executive orders as he can, and he's gunning to beat, Ronald Reagan in terms of deregulation and making the economy less regulated, which is, as I said, good for deal-making activity, however you feel about what the individual impacts of environmental restrictions or M&A or antitrust are some of those protections that should be in place from those regulations. So especially in subjects like AI, we can go down a different rabbit hole there. As I said, the second chart on the right is looking at the debt to GDP ratio of advanced economies. The line is the United States. The blue dotted line is if we were to allow the Tax Cuts and Jobs Act to expire at the end of this year. The orange line is the trend of where we're going if Trump extends all of the tax cuts that are currently on the books. So that's the range of what we're talking about when we look at a House budget. We do expect that he's going to try to extend many of those cuts. But he may do it for a shorter period of time, think 3 or 4 years rather than 10, because that makes the bill look less expensive and more likely to pass through the House.
What does that mean in layman's terms?
So when you calculate the cost of a tax cut, it's a cost per annum. So when the Congress goes to pass the bill, the total cost of the bill is 10 years of that tax cut, of the reduced revenue. So if you shorten, one tactic for this is to shorten the length of time that the tax cut is in place, makes the bill amount that hits the headlines look cheaper. So Biden, during his administration, wanted to make it look bigger, $1.1 trillion of infrastructure spending, even though that was happening over a decade. And now the tax cuts, you're going to play the opposite game where they're trying to shrink the cost of the bill by making this...
The media costs, yeah.
Right. So what's on the Trump agenda?
I do love layman's term and the use of Anna in layman's term. You're doing the best you can.
I'm trying. So what's on the Republican agenda for the sweep? Taxes and the deficit. So like I said, they're going to try to extend as many of those tax cuts as they can. It's going to be tough to get it done for a long period of time. Locally speaking, or in our world, we keep a close eye on the top income tax rate, the things like the 20% deduction for business owner income, capital gains tax rate, the estate tax is extremely important to my client base. Watching to see very closely if any of those things get extended. We aren't going to know until the end of this year. The budget that's coming out in the first quarter of this year only tells us the scope of what they're trying to get done. They're not going to hit us with any of the details of how they actually want to pay for this until the third or fourth quarter. So even at my next update, we probably still won't know yet.
So you're talking about some of the national level stuff, and I have a number of local questions. But I mean, I assume your bank also looks at what we've talked about with state income tax and local, what's the view from the bank from some of those proposals?
In Louisiana in particular, I mean, we seem like we are gunning for a 0% state income tax. So we reduced our top tax rate this year from 4.5% down to 3%. They seem like, Governor Landry wants to eliminate that state income tax eventually and find other sources of income to replace it.
Yeah, I just haven't heard anything. Does the bank have any, what are their thoughts on the national debt? I mean, is there no conversation at all?
There's a ton of conversation, but it's not it's not a major cause for concern. As long we watch very carefully, and the thing to watch is the 10-year Treasury. And this is towards the end of this quarter. When you see the budget proposal come out, watch the Treasury rate. So right now, the Treasury is hovering around 4.6%. I think we closed yesterday at like 4.58. If the market has concern over U.S. debt levels, when they see this budget come out, you're going to see that Treasury spike. It's going to go through the roof. And if the market does not like the Republicans' budget plan, if they think it adds too much debt, that's when we have a problem. As long as the marketplace of foreign buyers, U.S. buyers, hedge funds, everyone who buys U.S. Treasuries is willing to get on board with the budgetary plan, the national debt is not yet of concern. When you lose your buyers, the people who fund those treasuries to fund the government, that's when you've got a problem. So watching the market conditions very carefully.
Decision makers, so.
I mean, at the end of the day, Trump does care quite a bit about what the stock market thinks as well as what the bond market thinks. And we've reached a point where the interest expense on the federal debt is a significant chunk of the spending that we can't get rid of. And so having those rates spike is both unpalatable because it means the market doesn't want to pay for your tax cuts or doesn't want to pay for whatever you're proposing, but it also worsens the problem if you were to push forward because that increases the cost of interest cost on your debt as well. So there is a market pushback. There is a point where if you see the U.S. 10-year hit 5.5, anything higher than that, this whole bill and everything that the Republicans want to push through is going to become unpalatable. The U.S. is maybe one of the hardest countries in the world to gauge whether you have a debt problem because we are the global reserve currency and because we are one of the largest and most liquid bond markets in the entire world. So the market really is the best place to determine if you have a problem.
And our ratio is still quite healthy. I mean,
compared to Japan, sure. Compared to Italy or Greece, exactly. But I've got an interesting other slide here that I want to hit on really quickly. Okay. But this is tariffs are definitely elevated. Expect more tariff talk through the rest of this year. I've got a better slide next. Immigration, I just want to hit on your point. Through the Biden years, we've been seeing 2.5, 3 million net new immigrants over the course of this year. That's expected to fall to 500,000. So when you think about unemployment, when you think about the impact of AI, immigrants have been filling in the last 2 years more of the new jobs created than U.S. citizens, and the unemployment rate is still at historically pretty low.
So that's 4.5 million, even if 300,000 federal employees going to go back to work. There's certainly other jobs.
There's 2.5 million other jobs that we had previously been filled by immigrants that are not going to be.
Is that broken down into type of jobs? Are we talking about just labor jobs, or are we actually talking real jobs, meat and potatoes?
Well, that's a good question.
Break down at all in that data?
So yes, it is broken down. It's certainly heaviest hit in the construction, agricultural, service industries, and it is also heavily concentrated by state. Nevada, Arizona, Texas, California. This is definitely a localized issue, and it hits really hard. I would say the construction sector is probably one of the places to watch.
So do we see real wages declining?
This is a finely tuned dance that we're playing between the impact of AI and efficiency pickup versus the lack of immigration and what we call structural unemployment.
Because you kind of almost wanted to, in a way. I mean, nobody wants to take home less money, but all these things we're talking about.
Net, we believe that U.S. wage growth will still be positive this year. And in fact, we believe that U.S. wage growth will be higher than inflation. That's a good thing, full stop. That's what you want. That's what the Fed is trying to manage to. The problem that we were having during COVID is we had super high wage growth, but inflation was even higher. So net, your paycheck didn't get you as far. So our expectation for this year, if it's 3% wage growth but 2.5% inflation, net, your average household is better. The problems are structural employment. If AI eliminates the job of a call center employee, you can't just ship them out to a construction site and have them start building. It's
untrue.
Yeah, you can try, but it's going to. There are some.
Weren't we already shipping that out to halfway around the world to begin with? I thought that's what, you don't see so many call centers in the United States. All that's been outsourced around the world.
Yeah, to some extent. There's a lot here.
Still,
so all of my client service folks are based in Houston, and our major administrative offices are based in Plano. So there are still back office functions that there's a lot of them that are still U.S. based.
So, like we're reducing the immigrant, but like with the whole restriction of like food stamps and benefits from the government and all that stuff, by them slowing that down and removing people from there and forcing people to get jobs, wouldn't those kind of fill those kind of jobs that we're
looking
pushing
for
out the immigrants?
We are looking for the net impact of all of that, and it's to be seen because we are still getting like policy numbers in real time, and some of this stuff sort of blindsides us. We were not expecting, the government buyout offers. So we'll be watching this on. It's too soon to tell whether net more jobs are being created or new people being forced into the labor market. The way that we monitor that is called the labor force participation rate. It's actually been at quite elevated levels. So the labor force participation rate is the percentage of the United States population that is looking for a job. So, looking for a paycheck type job as opposed to single working households where one spouse stays home, or students, or people who are on medical disability are not looking for a job for any reason. Yes, if a change in government policy pushes the labor force participation rate up, then unemployment, the statistic, will tick up as well. And so, I don't have the answer to your question yet, and that's because we're getting some of this policy data in real time.
Okay.
Okay, sorry, one more slide to hit on the tariff subject. This is the history of United States tariffs. Tariffs used to fund almost 100% of the entire United States government. We decided that was a bad idea, so we introduced other things like the income tax rate, capital gains tax rate, all those things. The dots on the right-hand side of this chart show you if Trump were as bad as his threat, on all of his threats, where would the tariff rates go? And so the lowest dot is if we were to impose simply a 60% tariff, but exclusively on China. The second dot is if we were to impose a 10% universal tariff on all of our trading partners, Canada, Mexico, Europe, all the big guys who we do a lot of business with. And the green dot is if we were to do both. And so this remains to be seen where we will land. Based on how, again, Colombia went down and how things went down during the first Trump administration, it strikes me as a bring them to the table negotiating tactic more than an actual revenue-based policy.
Right.
But this is maybe the best chart I've ever seen to outline the scope of the issue of like what are we really talking about in terms of tariffs.
But let's say we ended up at a 13%. That middle, does that fund the U.S. government?
No.
Not like a fraction still.
No, you still have a budgetary shortfall.
Yeah.
It's that tariffs alone are not going to plug the gap.
Because we continue to overspend, pick up debt, and we have a multiplying problem that we almost need we need a lot of things to happen.
We either need to raise revenue with a combination of tariffs and taxes and all of those things, or we need to relook at the entitlement spending that we do. So there are large fundamental problems.
So we're just doing it all right now.
We will see.
We are seeing right now.
Yeah.
Yeah.
So the other thing about tariffs, and I said this last time, one of our chief economists, Joe Seidel, put out a piece outlining this for everyone because it's been, I guess, debated. But tariffs are both inflationary. They drive up the cost of goods just because things cost more to import. And they are negative for GDP growth. They are bad for the economy. So the reason why, and why I believe some of this will be enacted and others won't, is when you have a strategic interest. So when it comes down to whether you really want all of your semiconductors to power AI to be coming from China and all of your processors, rare earths, to come from China, or all of your other goods to come from another place, if you have a strategic interest, and there seems to be bipartisan support from Congress that there are certain strategic interests that the United States needs to protect. We know it's inflationary, we know it's not great for the economy, but we're willing to do that to protect certain goods that we want to make sure that we have that production capacity here in the United States. But from a security standpoint. But when you look at the second one, which is a 10% universal tariff on all of our goods from Mexico and Canada and the European Union, that's the one where I stop and say, but why? I don't feel terribly threatened by Canada, but or much reason to put tariffs on there. I take that more to be a negotiating tactic that Trump wants to bring whoever the new prime minister will be to the negotiating.
But yeah, on the military side, I mean, it's probably the hottest that I've ever felt it when we. Us just talking war with China right now. I mean, it is not. Our approach is it's not if, it's a when, and we assume the when is soon. I mean, that is not to like go fearmonger everybody, but like that's at least the way we want to posture ourselves and prepare ourselves. And so when you think about really like our local, your own individual troubles almost immediately, it's with chips, right? I mean, you can't, I hope you have a car that you like forever. I hope you like the phone you have until the war is over, unless we were building all this back here, which we have years of catch up to do in the best case scenario. And so this is where like some of the national security conversation comes in with China's tariffs, and should it be a whopping 60%, which is
great.
But
all right, I am way over my time,
also,
but
isn't this in hopes that we can bring some of these businesses back to America?
Manufacturing back to the United States, yes. But to my point, the net effect of when we've studied that is when you're re-onshoring this stuff, the goods are more expensive, and net there's less production overall.
Okay, real estate.
Hang on. The reason I want to hit, the way I want to hit on real estate is just to talk about the consumer for a second, and I've got my mortgage rates in here as well. We'll get back to questions right at the end. So, chart on the left, household debt as a share of household net worth. This is the other point I wanted to make on the U.S. national debt. Part of the reason that our buyers of treasuries are not so worried. U.S. household wealth has surged, both because the value of the real estate that they hold has surged, as well as their stock market investments and their net after inflation, all the things. So to look at this chart may not be what you were expecting to see in terms of the shape of the average American consumer, that they have less debt on their balance sheet as a percent of their total assets than they've had in 50 years, many years. So this is a positive trend.
Yeah.
When you look at, we keep looking at debt to GDP ratio for the Treasury.
Thank you. Okay.
But I don't really know why, because you don't tax GDP. You tax the wealth of your
But yeah,
tax
it could
base.
be this against liabilities, in which we all, if you go to like the GDP clock, whatever, debtclock.com or whatever, and you can see each person owes the government $100,000 right now, right?
Yeah. But so each person owes the government $100,000, but the U.S. household's ability to pay that is actually better than it's been in many years. So while debt to GDP looks like a concerning ratio, debt to average citizen wealth is actually pretty good. That tells our Treasury buyers that in a pinch, if the government's economic plans really don't work out and they had to raise the taxes from their citizenry, that there would be something there to do it with. This is interesting just in the trend of who's going to be buying homes. The bar on the left is in 2019. The bar on the right is in 2024. Pre-COVID, millennials and people of my generation, I guess, were doing worse than any of their predecessors at the same age. 5 years later, they are ahead of the pack in terms of their wealth and ability to spend.
This is so good. I mean, we've hit on this a number of times. and it's hard because I think we're all used to working with older people. Mm-hmm. Right? I mean, isn't that generally how we
find
feel?
some young people?
And this has changed so much in the last few years.
Because they've gotten better at stock market investments, the cost of getting invested, there's commission-free online trading everywhere. They've had an interest from a much younger age. This shows me that they have participated in the last 5 years of stock market run. They've been saving. They've gotten upgraded their jobs. It's crazy because I remember just millennials constantly complaining we're the most disadvantaged generation ever. It's not true anymore. So,
you mentioned stock market. Do you know the volatility of their investments? Is it Bitcoin?
Yeah, it could be quite a lot of that. So this on the right-hand chart is the stock market holdings as a percentage of that wealth. I'm sorry, this is the total value, so you can see those wild fluctuations in value. Yes, younger people tend to be invested in higher risk investments.
Well, probably tend to be, but right now probably the craziest of ever.
Yeah. So, what else do you guys need to know? U.S. consumers in better shape than international. I'm not sure you care about that.
Yep.
The cost of mortgage interest relative to disposable income is still actually at pretty healthy levels compared to where it's been historically. The noise or the thing that came out last time, but it seems like the consumer's really in trouble. And so what you've seen in that orange line is the cost of consumer debt as a percentage of disposable income, auto loans, credit cards, whatever else you got is higher. That has picked up. So I think what that means to me for your buyers, your lowest qualified buyers are going to be struggling the most. That bottom quintile of income earners, they've got higher debt levels because they're the ones who hold the credit card debt. They're the ones who are struggling with their auto loan. The smaller, boiling it down for you guys, smaller homes are going to be harder to sell. But the millennial who's been a saver, who's been doing something, and is finally ready to buy their first house or something of that nature, they've got more in the stock market, better debt-to-income ratios on average. Those middle quintiles or quartiles of clients are in better shape.
Yeah, you'll be shocked how much a 24-year-old has in their accounts.
I know. This is an interesting stat for the housing affordability restoration in light of rising mortgage rates and all that stuff. So this is broken down by individual markets based on how much the housing prices appreciated in those individual markets is going to determine how long it takes for housing affordability to be restored. I guess the point of this slide was just to say, be glad you're not realtors in Miami. Because housing affordability there, because of the price appreciation in Miami, is not likely to be restored. On the left hand, it's if mortgage rates don't move at all until 2035. And on the right hand, if mortgage rates were to fall 1%, how much does that help you with average buyer buying the average house? That's 2024. I don't have New Orleans on this page. I'd love to see that data, but I would imagine we're a lot closer to Cleveland and Detroit in terms of the scope of the issue than we are Los Angeles and Miami. And so this is showing that same data at a national level. Hopefully we can get back to a point where housing affordability is on track to recover. Mortgage rates have obviously come down, but the average buyer is still locked in, and so you still have that issue where people don't want to sell their homes because their mortgage rate is low. Yep. The driver, you guys know this all better than I do, has been the light blue line, which is new home construction. We don't have as much of that here in New Orleans, but this is more relevant to the dark blue line is probably more what you guys have been feeling in terms of existing home sales. So these are mortgage rates as they stand today in the private bank. We have changed our pricing slightly, so you can see the first bucket is for clients who keep $3 to $10 million with us. But the point of this slide is to say that that upward sloping yield curve has meant that my 3 and 5 year ARM rates are almost a full % lower than my 30-year. And as I was showing on the previous slide, a 1% shift in mortgage rates does help your ability to afford. And so be thinking not only about 30-year mortgages, be thinking about ARMs, be thinking about other financing options. It may make that purchase more comfortable for the client, but the other side on the underwriting that I want to make sure you guys all know is that ARMs and interest-only mortgages, for dollar, a $500,000 ARM is harder to qualify than a $500,000 30-year fixed.
Right.
So make sure you've got a qualified buyer as you're having this conversation, but the lower rate might make them feel more comfortable than going with a 30-year.
Doesn't make me more comfortable, but yep.
All right. Did I have other questions?
No, here first.
Oh, no, right. I'm sorry. He was waiting for a
I'd
while.
rather take the percent.
I know, like the president had mentioned, interest rates are trying to get interest rates down.
Yeah.
And so, do you think that do you think there's no chance today that there's a rate cut at all? And then for the rest of the year, like your outlook as far as
for
like
how
what
long?
like what. So Powell is supposed to be like an independent person or whatever, but if the president wants to raise down,
Right.
he gets his way.
Here's your chart
Look,
on the left. So this is the Fed and their outlook for rate charts. Each one of the dots on this page is a FOMC board member. And the FOMC board, these are the guys who vote and decide whether rates go down or come up. They are an independent board. They are not supposed to be influenced by the president, Congress, or anyone else. They are supposed to be making this decision based on their dual mandate, unemployment, and inflation. That's how the decision is supposed to be made. The charts on the right is all of the factors and the metrics that they look at in terms of determining whether or not to cut. And so you can see they don't agree. There's pretty wide dispersion amongst FOMC board members of where the terminal Fed funds rate should be. Lowest guy is down there at like 2.25%. The highest is up there at 4% for the terminal Fed funds rate. So rational minds can disagree on how many Fed rate cuts we will see. We charted the Fed funds future as well as the median. We think that there's another rate cut or two left in this cycle, and then you pause to reevaluate where's the economy, where's unemployment, where's inflation. Yeah, we're talking about this year.
And when do we get a new chair?
Oh, I don't know that.
Okay.
I probably should.
Yeah.
Okay, may I ask, it might be a little off topic, but you brought up trading. Can I ask, what is your thoughts on cryptocurrency?
Oh, my personal thoughts. CEO of my bank is not a huge fan of cryptocurrency. I believe that cryptocurrency can be a store of value. What we've seen in terms of transaction activity is that it is not replacing the United States dollar. Cryptocurrency is not replacing other forms of currency as a means of transaction. It is...
Or currently?
Currently. That's
Okay.
not the trend. What it is replacing is a store of value. I like to call it millennial gold because the boomers all love buying gold and the millennials like buying crypto. And it's kind of similar in terms of use. It doesn't generate any yield. It doesn't pay you interest. It doesn't, as a store of value, the only reason its value is there is because we all agree it has value. Right. So it's a store of value. And so the best comparable that I have is gold. If central banks start adopting it, the way that some central banks have adopted gold, and they do buy gold to hold on their reserves, that's obviously a positive for the value there. Me personally, it's not my favorite investment because that is all speculative. And not only that, but governments are not a fan. Go ask China about not having capital controls over money that leaves their country. So things like Bitcoin that are deregulated, decentralized, all the reason that the crypto people love crypto is the reason that central governments hate it.
But we have a huge signal from the current administration that we have turned to 180. Trump has turned to 180.
And we're going to be,
And we're going to push it from the executive side. What's that?
So what I will also say is there's a difference between cryptocurrency, the currency, the thing, and the technology behind it. Because the technology behind cryptocurrency is extremely powerful. And that can be we've talked about this for real estate people, because if you can turn real estate title into a non-fungible asset, it can be transferred and moved with no title attorney involved. So the power behind turning something else into a digital token that can be exchanged more readily is an extremely powerful concept. The way that I have to issue new stock or debt funding, that could completely change the way that our financial system operates. I hate that it takes me a whole day, 24 hours, for a stock trade to settle. That could be happening much faster if we were adopting some of the technology behind cryptocurrency. But if you're asking me about Bitcoin itself, I call it millennial gold. Not to say that it doesn't have value, but it's just,
We're way over on time.
Way over. Thank you all.
Can I have 1 minute though? New Orleans economy next year. What happens? Tourism, like what's
2025 tourism outlook is quite bullish. We have a pretty full slate of agenda for the conference center. So it does look, 2025 looks to be like the strongest year of conferences that we've had post-pandemic. Yep. So that's a positive or bullish sign. And then the Louisiana economy as a whole, things like the Cheniere plant, the Venture Global plant, Louisiana is poised to become one of the largest natural gas exporters in the country. Plants number 1 and 2, the first largest and second largest natural gas export plants, are both in Louisiana. One's out.
Quick, Bill, how about there's a big lawsuit to stop Bill Roller right now going on down there? Is that the case? Or
There's plenty of lawsuits. Okay. Whether I think the lawsuits will stop it.
I'm tracking they're going forward.
So what about the port, the Deepwater Port? They're going to keep building that?
The port? Yeah. So further moving our Port of New Orleans further downriver, there are 5 ports in South Louisiana. And so we look at all these metrics and we try to compare ourselves to Port of New Orleans versus Port of Galveston or Houston or whatnot, and it looks like we're losing and all this thing. It's because we have built a series of ports around South Louisiana that in aggregate are much more powerful than any one of them combined.
That's what you do when you do it on a river versus a Gulf or coast.
And so there is a significant amount of reinvestment that's being made in the Port of New Orleans, which is in particular our container port as opposed to our bulk cargo port or a liquid natural gas port, et cetera. So I would say outlook for the Louisiana economy is driven by some temporary but extremely powerful construction trends.
Awesome. Thank you so much. Appreciate it.
Thank you.
Yep. All right.
Appreciate y'all.
Take a little clicker.
Oh, you got the clicker.
Yep.